I bet you would want to know how hedge funds are trading crypto. I don't blame you. I would personally love to know how these opaque operators are navigating these volatile yet lucrative markets, to maybe glean some insight that could help inform my own strategy. Well, thankfully, we have a recent hedge fund survey that is a wealth of information. The only problem is that it's over 40 pages long. So in this video, I'll be breaking it down and succinctly giving you all the information you require to handle these markets like a hedge fund pro. I'll also be sharing some of my own opinions around hedge fund crypto investing and what it means for the market and price. So, if you want to be 2 steps ahead of the retail pack, this video cannot be missed. Damn, I can't get any matches. It seems as if all the ladies are only interested in financial advisors. So, what that means is that I'm a sad guy, and it also means that everything in this video cannot be used as financial advice, purely educational. Now, with that heartbreak out of the way, I would like to welcome everyone new to the channel. No, this is not a crypto matchmaker, but it's a channel with the highest quality crypto content around. News, reviews, token overviews, and general market moves. So if that's something that sounds of interest, gently click that subscribe button. I would also encourage you to turn on all notifications to make sure that you don't miss a single video. You don't want one to fall through the cracks. And finally, please direct your gaze to these wonderful timestamps. They are there for you to jump to those sections that interest you the most, although I would highly encourage you to watch as much of this video as you can. Alrighty, you guys keen to see what those funds are up to? The report in question was the 3rd annual Crypto Hedge Fund report by the folks over at PwC in collaboration with Elwood. Now, this was mostly structured as a survey where they asked a whole host of hedge funds about their crypto investing. Everything about the intricacies of their operations to funds under management and investment strategies. You can see the survey methodology right over here. There were numerous respondents to the survey, and not all of them were willing to disclose their participation. But for those that were willing, you can see here that it's a pretty sizable list. So, moving on to the first bit of information that we have, and that is the distinct relationship that we can see between fund inception and the Bitcoin price. This is obviously a no-brainer. Funds are not likely to want to launch into a crypto winter. It's that much more difficult to raise funds on Wall Street in a bear market. Moving on to the next charts, we have the distribution of investing strategy. This is actually quite interesting, as it lets us get a sense of which one of these is favored by the funds. The most popular is quantitative strategies. Now, these involve strategies that are usually market neutral, but take advantage of statistical arbitrage opportunities. Moreover, given the high intensity nature of these trading strategies, they require highly liquid markets. So we're only talking about the likes of the top 5 cryptocurrencies. The second most popular strategy is a discretionary long-short. This usually involves taking a view on direction up or down on a range of crypto assets. Third up, we have the discretionary long strategy. This is basically just buying particular assets and sitting on them as a HODL. I'm quite surprised to see that it is only the 3rd most popular amongst these funds. Perhaps this is because these funds are incentivized to show alpha above just the standard Bitcoin price. It's a bit like how traditional hedge fund managers are benchmarked. They're usually compared to their performance against a standard allocation to the S&P 500. If you're only ever giving market returns, this means that you are adding very little value. Therefore, if an investor in your crypto hedge fund can make a similar rate of return just by hodling Bitcoin, well then, you're redundant. Anywho, the final strategy here is multi-strategy, which incorporates all of the above. So, what does this all show us? Well, it shows that crypto hedge funds are a lot more active in their trading. They use advanced algorithmic and market-making strategies to snipe alpha above the market rate of return. They also actively short cryptocurrencies and are less interested in longer-term holding. It also shows me that they are more than likely to try and take advantage of market idiosyncrasies. perhaps playing both the spot and the futures markets and taking advantage of inexperienced retail flow. On to the next chart though, and this is a breakdown of the investor profile of these funds. Here you have the types of investors that are allocating money to these crypto funds. As you can see, the bulk of the funds are coming from high net worth individuals and family offices. The percentage of funds that are coming from other types of institutions, fund of funds, asset managers, etc., is negligible. Now this also makes sense when you think about it. High net worth people generally don't have fiduciary duties to meet as it relates to people who have invested with them. All they have to worry about is their own money, and if they want to invest in crypto, no one is stopping them. The same can be said for family offices. They are basically another variant of high net worth individuals. They are investment groups that invest exclusively on the behalf of very rich people. These rich people usually set a mandate and a target, and these family offices try to meet it. However, when it comes to mutual funds and other asset managers, the hoops that they have to jump through in order to invest in the cryptocurrency market is much larger. Those who invest in these funds include pension funds, retail investors, and other asset managers. The stakeholders generally have a lower risk tolerance. And even if they were to invest in crypto, the amount that they could invest is much smaller as a proportion compared to high net worth individuals. Now, this is unfortunate as it means that the most likely people to really benefit from the returns being generated in these funds are not your average retail investors. It's more likely to be those with substantial wealth already. Just below the investor profile, you also have a rough guide as to the size of the tickets, investments, going into these funds. More people are investing less than 500k. However, the large tickets by some whales mean that the average ticket size is pushed well above 1 million. When it comes to fund AUM, it's no surprise that the amount has increased from 2019 to 2020. Markets are up considerably. This is also clearly visible from the distribution charts of that AUM. As you can see, there are many more funds with assets under management above $20 million in 2020 than those in 2019. Okay, so that's the lay of the land in hedge fund country. However, one of the most interesting stats that I want to take a look at is the performance of said funds. Over here, we have a chart that shows the relative performance of the different strategies in 2020. Right off the bat, you can see that the strategy there that sticks out the most is the discretionary long only. This had the highest performance when looking at both the median and the average performance. I should also point out that the performance for the quantitative long-short strategy also had the worst relative stats. If you'll recall from just a bit earlier, the quantitative strategies were the ones that were most favored by these funds. However, when looking at the numbers, the less popular long-only was able to get the most returns. It's also greater for the case where some of these funds have been dabbling in a bit of short selling. Even if we were to take a look at the performance of these strategies in 2019, the marginal outperformance of the long-short strategies did not justify the underperformance in 2020. On average, if you had been investing in a fund that employed the standard discretionary long strategy, you would have been better over the 2 years that it was tracked. So, although funds are more interested in running advanced and sophisticated algorithms to beat the crypto markets, they come up short compared to simple buy and hold. This is perhaps further evidence of the strength and virtue of the HODL. Find those coins or tokens that have the most solid potential and invest in them for the longer term. For those who follow my investing strategy and cryptocurrency portfolio, you will know that it is the strategy that I employ myself. Moreover, if these highly advanced crypto hedge funds using sophisticated trading algorithms can't beat a buy and hold strategy, then you will struggle to as well. This is another reason why I discourage repetitive day trading, especially when done with leveraged trading products. Not only will you find it hard to beat the buy and hold strategy, but you also risk completely depleting your capital. And the stats get even more illuminating when we compare the returns to that of Bitcoin itself. As you can see, none of the strategies beat the Bitcoin performance in 2019 or 2020, not even the discretionary long strategy. So even if you were more discerning in the types of coins that you picked, over the year you would still have underperformed the Bitcoin benchmark. Of course, it's important to note that this performance chart over here does not take into account the volatility of each of these strategies. While that's not something a diamond hands hodler has to worry about, it is something that a hedge fund has to take into consideration. These funds have to issue monthly performance stats, and if they have returns that are all over the show, it could scare off some of the more conservative potential investors. Perhaps this is the reason that these funds have favoured quantitative strategies. Given that these are generally market neutral, they could be less volatile. Now, the next interesting page that I want to look at is that which deals with their trading of specific cryptocurrencies, especially those in the DeFi space. Over here, you have a breakdown of how these funds are utilizing their crypto. The bulk of them seem to be staking it. Now, this could make sense if the staking allows them other benefits, such as more weight in governance decisions, as well as being able to run their own stake pools. Next up, you have quite a few funds that appear to be lending their coins out for additional returns. This could either be through DeFi protocols or centralized lending platforms. Borrowing funds appears to be less popular. Now, I suppose this is because they may have defined leverage limits, and borrowing additional funds could push against these. I'll come back to this in a bit. Moving on, we have this chart, which shows the breakdown of the individual assets that are traded. As was expected, Bitcoin is the most popular, with over 56% of the trading volume. It's the most liquid, and hence it is the one that most aligns with those quantitative trading strategies that they're so keen to employ. The next most popular is, of course, ETH. However, I'm surprised to see Litecoin at number 3. It has a lower market cap than some of the other altcoins on the list, but has a lot of interest from these institutions. If you want to get an idea of why this could be, then I encourage you to check out my recent video on Litecoin. That's linked to in the top right. The trend is also evident for some of the other altcoins on the highly traded list. For example, Aave was traded with higher frequency than the likes of ADA, despite having almost a tenth of the market cap. As I've said on a number of occasions, Aave is building one of the most powerful DeFi lending platforms on the market, and the price action of Aave's token since transitioning from Lend last year has been spectacular. Something else that I find quite illuminating here is the diversification of trading among smart contract blockchains, perhaps as ETH 2.0 hedges. You have the likes of DOT, ADA, Atom, and Tezos, all of which are developing their own solutions. On to the next page over here, and we have a breakdown of leverage and derivatives in their investing strategy. As you can see here, over half of the funds surveyed are allowed to short crypto assets. However, only about 30% are actively shorting crypto assets. We can also tie that in with this chart over here, which shows how many of these funds are using leverage. 51% of these funds are allowed to take on leverage according to their prospectuses. However, only about half of those that can decided to do so. I guess this is quite telling in general, and something important to take into account for your own investing. Shorting cryptocurrency with leverage is not a popular investing strategy, and you should not be doing it. Of course, it's your money, and I am not a financial advisor. The next page here is perhaps one of the most interesting for me. This shows that these hedge funds are actually using some of the same decentralized exchanges that you and I use. In total, about 31% of the funds stated that they had used a decentralized exchange, and it was broken down by these top 5 over here. No surprise that the top option is Uniswap. It's got the most TVL and liquidity amongst all of the other exchanges. You should also note that the second most popular option there is 1inch. I'm also quite a big fan of it because it is an aggregator of numerous other DEXs. I also have a feeling that these large crypto hedge funds could be behind the exorbitant gas fees that we're seeing. If they're using quantitative strategies in the DeFi space, then you can be sure that these are chewing up computational resources on the network. For any DeFi degens watching, you will know how much gas it can sometimes take to engage in those mind-melting DeFi arbitrage trades. Now, you can only imagine how much the gas fees must be when these funds are moving millions through these pools. I also think that it's likely to get that much crazier on rumours that some titans in the hedge fund space are setting up crypto funds. Not only that, but these funds are eager to start using decentralized finance platforms. The funds include the likes of Millennium Management, Point72 Asset Management, and Matrix Capital. They have $51 billion, $22 billion, and $10 billion in AUM, respectively. I don't want to even know what these guys plan to do in the DeFi space, but it's probably going to involve a lot of gas. When ETH 2.0, hey? And speaking of traditional hedge funds diving into crypto, I happen to think that we will see a flood of further entrants on this front. That's right. PwC and Elwood also partnered with the Alternative Investment Management Association to get information on traditional hedge funds. This survey was conducted during the same time frame as the previous one, except in this case, they spoke to 39 TradFi hedge funds with a combined $180 billion in AUM. You can see a breakdown of these funds over here. So yes, the real big boys. Now, when asked about whether they had invested in crypto at all, only 21% had taken the leap. However, for those that had taken this step, the average amount that was invested was a relatively minor 3%. You can see the more granular breakdown here. So what that means is that crypto still has some way to go in the portfolios of global hedge funds. Almost 80% of the hedge funds in the survey have not touched crypto, and those that have only really just dabbled. There is hope that the AUM deployed to crypto will increase, though. That's because of the fact that almost 90% of those who have invested in crypto this year will add more to their portfolios next year. This next chart here is also quite illuminating. It asks the investors the primary reason as to why they invested in crypto in the first place. Interestingly enough, general diversification is the primary rationale here. Over 57% of the respondents invested in crypto because they wanted to find a way to hedge other portfolio risks. I am, however, surprised to see that a reasonable contingent of these investors view it as an inflation hedge. As I've covered on the channel on many occasions, Bitcoin is one of the premier inflation hedges out there. Feel free to watch my most recent Bitcoin and inflation video after this one is done. Link is in the top right. Now, something that really did surprise me in this survey was the supposed challenges that these funds foresee for investing in the crypto space. Firstly, when it comes to those that have already invested, the main challenge they seem to be grappling with is that client or reputational risk. And the challenge that bothers them the least is the actual volatility. Just consider that. These hedge funds are more worried about the perceived blowback they will get if they invest in cryptocurrencies than the actual volatility that comes from said crypto. Who would have thought that there would be such a stigma to crypto on Wall Street? Now, another really big concern for these funds is, of course, regulatory uncertainty. No surprise there. It's not like regulators are trying to make things all that easy with their constant flip-flopping and jibber-jabber. They also asked the same question of those hedge funds that had not yet invested in crypto. And here you can see the results of that. As you can see, regulatory uncertainty and client reaction or reputational risk are the biggest concerns. While volatility is a bit more of a concern for these crypto virgins, these two responses here are quite illuminating. And that is that only about 35% of these respondents don't believe crypto has value, and only 33% think that the current prices are unattractive. So of all the things that these hedge funds are worried about, the long-term value and current price levels are not their biggest concerns. Who would have thought? Time to start wrapping this video up, folks. Now, in case you've not noticed, I really do like to dive into institutional reports like this. I just can't help myself. I've done so for many others and intend to continue doing so in the future. Seeing exactly how institutional investors are playing these markets allows us to better navigate them ourselves. Studying their investing methods helps us better refine our own strategies. In this particular survey, we learned that although these investors prefer to use quantitative strategies, those that offer the best performance are simple, discretionary longs. Whether their decision to run these more market-neutral strategies is based on mandates or risk is unknown. The main point is that they are suboptimal in the long run. I was also really surprised to learn that so many of these funds are diving right into DeFi. They are swimming in the same liquidity pools as you and I. Yes, this is a killer for gas fees, but we know that proof of work is a legacy issue. I think it's broadly positive, as not only does it increase liquidity, but it also shows that DeFi is no longer just a degen's plaything. However, despite how much the crypto hedge fund space is growing, there is just so much more space to grow. Only a very limited amount of TradFi hedge fund capital is deployed to the crypto space. What is most surprising to me is the reason why these funds are so hesitant. It's not volatility or price levels, it's perception and regulation. Perception because investing in these assets could scare their investors, and regulation because, well, politicians. But at least there is a trend of adoption in the institutional investor space, and those that have invested are incredibly bullish. The survey also asked these crypto hedge funds for their end-of-year price predictions. Over 65% thought a price between 50k and 100k. A further 34% thought it would be even higher than 100k. Only one respondent out of all participants thought that we would be below 50k. So, ask yourself, what makes these guys so bullish, and do they see something that you don't? That's all for today, my loyal subscribers. However, it is time for me to hand the floor over to you. So, what did you guys think of the report? Any questions for me? Fire them below. And while you're down there, you absolutely have to check out my socials page. This has links to all the other places that you can follow me off the tube. These include the following: my Telegram channel, where I share market analysis and views; Twitter, where I share news and other tips; Instagram and TikTok for behind-the-scenes views and memes; and, of course, my email newsletter, where I share a breakdown of my personal portfolio as well as a breakdown of some upcoming videos. All of which you seek is there at the tippy top of that description box. Finally, if you found this video fine, then fire up the likes. Don't forget to subscribe to make sure you're in line to receive my latest crypto vibes. Oh, and hit that bell as well. We don't want it to get lonely. That's it for today, my fellow crypto fans. Guys, gotta fly.